Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is August 30th, 2025. I am Luna.
I am JPMorgan. S&P 500 down about 0.6%.
Yeah.
NASDAQ lost, roughly 1.2%. And the Dow dipped around 0.2%. Now, those numbers, they seem kind of modest, right?
It's on the surface, yeah.
But the real story, maybe for your portfolio, was in tech. Dell plunged nearly 9%. Nvidia slid 3%. And this wasn't just like random noise.
No, there were reasons.
Yeah, it seems driven by talk of rising production costs, maybe a more cautious outlook from those big names. But here's the interesting part. Even with that Friday dip, the S&P 500 still clocked its fourth straight monthly gain in August, up 1.9%.
Right.
So does that difference suggest, a healthy rotation? Or is something maybe more fundamental building under the surface for investors?
That's exactly the puzzle. And the bond market, actually, it gives us maybe a clearer signal here. What's really fascinating is the 2-year U.S. Treasury yield.
Okay.
It had its steepest monthly drop in a whole year, down about 0.32 percentage points just in August. Now, that's not just a number. It really reflects a strong market conviction that the Fed is heading for rate cuts.
Yeah.
Futures are pricing in something like an 85% chance of a quarter-point cut in September. So the market's definitely betting on easing.
And that sentiment, you see it in commodities too, right? Gold held near a 1-month high. It's on track for like a 4% gain for August.
Yeah, buoyed by that softer dollar. And again, those expectations of looser U.S. monetary policy. It's kind of an interesting hedge right now.
Okay, now here's where those mixed signals get really interesting. It paints a pretty complex picture for the Fed. We got some key economic data points that, while they seem almost contradictory. First, the U.S. goods trade deficit. It unexpectedly widened, and widened a lot, to $103.6 billion in July. That's a huge 22% jump from June, way above what anyone expected.
Wow, yeah.
So on one hand, maybe it points to really strong domestic demand. People are buying stuff. But on the other hand, that could directly subtract from Q3 GDP growth. So strong consumer, but maybe at a cost to overall growth.
Exactly. And then right alongside that, we got the July PCE price index, personal consumption expenditures. That's the Fed's preferred inflation gauge.
The important one.
Right. And it came in exactly on target, matched the consensus forecasts perfectly. Now, this is crucial because it reinforces that story, that narrative, that price pressures are gradually cooling off.
Okay.
So for you, the stability, it helps corporate profit margins, helps consumers' purchasing power. So to kind of answer your earlier question, you've got this really resilient consumer demand driving up the deficit.
Yeah.
But inflation measures like PCE are still behaving, still coming down. It creates this fascinating tension for the Fed. How quickly can they really cut rates if demand stays this strong?
That's a great way to put it, a fascinating tension.
Sure.
And it's not just a U.S. story either. We saw Canada's economy actually contracted more than expected in Q2.
Right, that was notable.
Yeah, down 1.6% annualized, worse than expected, mostly because exports just plunged,
Right.
7.5%. And that hit markets immediately. Canadian dollar weakened, bets on a Bank of Canada rate cut went up, shows how quickly things can shift.
Absolutely. And stepping back even further, there's a broader macro trend. Sovereign bond yields are climbing globally, mostly because governments are issuing a lot of debt.
Okay, so what does that mean for us?
Well, for you, it translates into higher borrowing costs, just generally across the board. And that can put pressure on stock valuations, especially in those sectors that are really sensitive to interest rates because money just gets more expensive.
Got it. So with all these moving parts, what's the focus for next week? What should you be watching?
All eyes on Friday, September 5th. That's the U.S. employment report for August.
The jobs report.
The jobs report, the consensus expects non-farm payrolls to increase by about 78,000, which would signal, a continued cool down in job growth.
Right.
This really is the big one for the week. If that number comes in significantly different from 78,000, either way, they could absolutely jolt the markets. Think about it, influences Treasury yields, stock prices, even riskier assets like crypto, because it directly shapes what everyone thinks the Fed will do next, especially about those September rate cuts the market seems so sure about.
So keep those economic calendars handy. We'll definitely be watching if that soft landing narrative holds up against all these mixed signals. Until next time, here's something to think about. What if next week's jobs report delivers a real surprise? Maybe much stronger or much weaker than expected. How might that completely flip the market's current thinking about those Fed cuts? And what could that mean for your investments? You've seen the headlines, but what really moves your portfolio? Money.ai scans 1.3 million signals a day, earnings, sentiment, macro shifts,
and turns it into one personalized briefing focused on your holdings. No noise, no guesswork, just what matters. Money.ai. Know what moves your money.